This video from the Brainfield channel is for you. Yes, you. You have been wondering what you are doing wrong in your investment journey, or perhaps you want a better way to invest your money in a way that will be profitable for you and your stocks. What better way to learn that than from the words of Warren Buffett, one of the world's greatest investors? Word has it that Warren Buffett began his journey into the investment world at the age of 11. This means he has decades of experience and helpful tricks up his sleeves. In this video, we will be sharing the 10 best investment strategies to use as an investor. Note that these are words and techniques used by the great Warren Buffett. If you are new to this channel, we post insightful videos like this. Click on the subscribe button to keep up with all of our videos. Number 1. For most people, this would come as a shocker. The IQ you need to make a successful investment is as much IQ needed in moving from the downtown part of a community to the city. You do not need an IQ limit for one that plays a three-dimensional chessboard. What you need is a stable personality. The kind of personality that can understand that you are not right or wrong because thousands of people agree or disagree with your strategy. You are only validated by the correctness of your facts and reason. To be a great investor, you need to have a personality that is great whether people stand with your ideas or not. Number 2. The cigar butts investment strategy. Many times, what most investors are taught is to pick up a seemingly lifeless business to invest in and wait for minimal returns from it. The cigar butt strategy would have you on the lookout for opportunities that appear to have a great return value if only you are willing to buy them at a very cheap price. Well, according to Warren Buffett, it is not a great investment strategy to venture into purchases on a quantitative basis. To be on the lookout for the cheap stocks, take just one profit from it and move on to the next cigar butt stock. The issue with this kind of stock is that because of the nature of the stocks, you cannot put as much money as you would have in a healthy business. The best returns come from being able to spot healthy companies and leverage their great health, especially if the goal is to maximize the profits from the investment. Number 3. Having small sales on great opportunities. In his words, we don't do many things, but when we get the chance to do something, you gotta do it. Like with almost everything there is to do in this life, great opportunities do not stay lurking too often, and when they do come, it would be unreasonable to commit little to them. Committing little is as much as committing nothing at all. Warren sees the investment world as an avenue where investors are given a 20-slot punch card throughout their career as proficient investors. Each slot of the card comes in handy when you have to decide to buy into a company. The idea is this: if you know little about a company, perhaps you get to know about it from words bouncing around during a cocktail event, and you would be less pulled into dabbling with this stock, just because. For each buy-in, you are one slot out. As he said, the good thing is you do not have to use up all of the slots. But when you get a good opportunity to use a slot, get into it well or don't get into it at all. Number 4. Your opinion about the market conditions does not matter. For him and his partner, they never really bothered about what the market condition says. The market always has something to say, and like it or not, it would more often than not contrast with what you find attractive to dabble into. To not take action on a market option you find attractive because of something you thought the market is going to do or not do, by doing this, you give up on what you know is profitable and settle for the chance of the unknown. This is not the best practice as an investor. If you are right about a business but decide to stick to what the market says, the chances that you would be passing on a great business opportunity are evident. This ideology of giving little thought to the market opinion on personal research business has worked significantly for him and his partner over the years. Do not trade what you know for what you don't and might never know. Number 5. The question on diversification. For Warren Buffett, the principle of diversification, as it is taught in most business schools, is an insurance policy for someone who doesn't know what they are doing, a backproof of ignorance. The idea of this principle is to ensure that whatever the outcome of the market, however the bad market situation is. So yeah, it is a great way to scale your investment if you do not know how to analyze businesses. However, if you are great at analyzing businesses, you would realize that the probability of coming across 30 or 50 great businesses to invest in is pretty low compared to the probability of coming across 3 to 5 great businesses. The problem with diversification is that when you have too many businesses on your watch that you believe to be attractive, it limits the possibility of getting a greater value off your investment. You cannot have all 30 businesses doing great. A greater number of them would probably turn your income low. But as he says, this conventional practice is great if you do not know how to analyze businesses. Number 6. The best and first investment you have to make is in yourself. You could learn all the skills there is to learn, but without deliberate investment in yourself, it might not amount to much. He uses communication skills as a reference point. If you have communication in the bag, you get to increase your at least 50%. How's this possible? Warren Buffett recounts that this is what he tells students of business schools about the life that awaits them in the business world, outside the comfortability of being a student. You need to be able to get your ideas out. Most investors are unaware of this fact, and the effect is seen in their actions. As he says, it is like winking to a girl in the dark. You know you winked at her, but she will never get to know of your actions because you failed to communicate them appropriately. Number 7. The myth of asset allocation. The usual method of investment goes with a set ratio of funds. It could be 60% allocated to stocks and the remaining 40% going into bonds. Then, when something occurs, a big announcement of activity by the company or other market movements, you decide to reevaluate the ratio to something like 65 to 35 or 35 to 65. This is the usual occurrence found with most investors, but Warren begs to differ. He believes that your default position as an investor is to have short-term instruments. Rather than try to meet up with them, it is more sensible to do what you think is intelligent. These businesses do these events and pass these announcements up with the goal of the action you are about to take in mind. You do not have a problem with the way you are doing things. Their goal as sellers is to make you believe you do. And by doing that, you are sworn over to doing their bidding and changing your investment plan as opposed to what you have intelligently planned out. You don't need to consult the experts to make your money. Number 8. Human beings like to gamble. There is no definitive reason why this is so, aside from the fact that humans are drawn to the idea of gambling, whatever form it takes. And in this case, it doesn't have to take the form of a casino slot or other types of casino games. It takes the form of something called day trading. How does this work? The same way gambling makes the odds widely above the normal limit, this is the same way day trading makes investors sit back and throw a couple of cents into the market through daily activities, sometimes going so high into the risk for a turnout. Gambling is a tax on ignorance. Number 9. Is there a major distinction between growth and value? For Warren Buffett, growth is a part of the value equation. They are connected as one. In investing the right way, you do not have to choose between investing your money in growth stocks or value stocks. To get more capital, you put out more capital. By doing this, the business grows. He explains that you could either decide to call this action value increase or growth, but it is all about interpretation and understanding the terms used as an investor. They are not separate categories as most investors have been made to believe. Growth stocks or value stocks. Number 10. The investment business is not like the business of a mortician who awaits events of cases of flu or epidemics before getting a shot at being great at what he does. As an investor, you do not wait to be a corrector. Sitting and hoping to buy in the throes of panic is not the move of a great investor. You do not wait for an opening for correction before you do something. This makes you invest using the techniques of extremities. Start with the Dow market index at X, then proceed based on the calculations of when to buy based on how the market moves from 90% to 50% and beyond. As an investor with this game plan, you would see yourself very rarely getting to benefit much from either of the extremities. The only time it could favor you is if you happen to come into accidental money that pushes you forward. Warren Buffett recommends that the best game plan is to find a good business to invest in instead of sticking with the extreme ends of the market value. He defines the context of good business to be one where your investment could be left with the broker with no attorney of record, and when you are back from your long years of vacation, your investment still stands good. This ends our 10 investment strategies from Warren Buffett. If you enjoyed this video, give us a thumbs up, and don't forget to share it with people that would find this helpful.